Okay, hello everybody. Welcome to Korean Atlanta Mentorship. And in this video, we're just going to do another velocity banking review. So, what is velocity banking? All it is a debt payoff strategy where you throw all of your money into debt with the help of something called a line of credit. And it's very obvious that this is something that most Americans don't do. They don't put all of their money into debt. And recently, the federal government resumed student loan payments, right, after a 5-year hiatus. I don't know if you can see this right here. So there were a good number of Americans who were just like, "Hey, I got student loans. I don't have to pay them." And then now the federal government's like, "Yeah, you do." And now a lot of people are they're struggling. And here's the thing, I'm never really sure of this, believe it or not, because every time I step outside my house, it seems like everybody's okay. There's like new housing being built and it's being sold really quickly. In fact, near my neighborhood, um, they're building housing, like new construction housing just for rent. And I looked at the prices and it's like $2,000 a month on average, 2,000, 2,500. I'm like, bro, like, I'm rich and I can't even afford that, right? Right? Like, not just for rent, but that's how I guess, the market will bear what the market will bear. Either people are really desperate for housing or they're rich, but maybe they're not, right? And, if you take a look here, I'm never paying back my student loans, and a lot of people like, I ain't doing that because, they got too used to doing, not paying back their debt, and we're gonna do the opposite today, which is just throwing all of our money into debt with the help of something called a line of credit. And what's funny is that a lot of people have always told me, or not always, but once in a while tell me, like, once I saw this, I was like really angry because I could have done things so much easier and better, right? So much easier, which is what we're going to do today. Okay, we're going to throw all of our money into debt. So, this is the first step to velocity banking is creating a budget because our budget is our debt attack plan, right? Income, expenses, leftover savings, expense breakdown. You list every single debt that you have, right? Every single debt, okay? And the whole point of this is to make sure everything in the black font eventually goes to zero. And then in the last line, you just kind of combine your operating expenses, expenses that are not debt, food, gas, insurance, things you always have to pay for on average. And we'll say $2,000 a month. Okay. Now, let's say we make the same income and we have the same expenses, right? This is the part that most people will not do, which is not save money. Okay. Not save money. And so if you ask the average person, like, hey, given the same income and same expenses, what's better, saving $246 versus not saving anything? And I'm going to show you how this looks like in real life because, again, you know, I've done this in real life, which is your checking account is pretty much going to stay zero. Money comes in, it's kind of like it just comes in and it's not meant to stay there, right? But for the average American, they're trained by society that your money should stay in your checking account. And so as soon as money hits my check account, it's gone, right? This number pretty much should equal this number, okay? And what we're going to do is once we get that money, we're going to move it into something called a line of credit. And so we're going to have a number called cash flow, okay? It looks similar to savings, but once we shuffle some debt, we're going to make this number increase, okay? And we're going to pay it off with something called a line of credit. So, what's a line of credit? All it is a financial tool where you could borrow money, pay it back, and then use it over and over again. So, you see this line of credit right here. This is my home equity line of credit. Click the button on the bank's website. They're going to dump $280,000 into my checking account and then charge me 7.5% interest. And I can use it to pay anything that I want. Anything, almost anything. It depends on the bank as well, because I remember the first HELOC I signed for, the bank made me sign like, "Hey, you won't buy stocks with this." I was like, "Okay, well, I guess I won't." But the second bank that or credit union that I used, they didn't have such a restriction as far as I'm aware. But you can use it to pretty much pay anything, right? You pay anything. And yeah, so By the way, before I get more into the weeds, just want to use this opportunity to brag that I paid off my mortgage in 2 years and 9 months. In fact, I've been saying this for the past, I don't know, 100 videos or so, I think. And I'm so sick and bored and tired of saying this, but rich people problems, am I right? 2 years and 9 months. Anyways, all right, so let's go ahead and get started. And let's assume we have $100,000 line of credit available to us, right? And I say this as a person who has over $604,000 in lines of credit. And this includes credit cards, personal lines of credit, uh, home equity lines of credit. And I'm going to tell you the secret of how to get credit, lines of credit, okay? Banks don't lend money to people who need it. And as long as you know that, okay, you'll know how to get credit. A lot of people don't believe this because they think the bank is there to lend you when you need money, but they're not. Because a person who needs money is considered to be a high risk borrower, and they don't want to lend money to people who need it because of the risk, right? So remember that. Now, if you're making 6,500 a month and you have all this debt and you have $246 of savings, okay, that's a high risk borrower. So what I'm saying is that the bank is not really going to lend you a free and clear line of credit, like a line of credit that starts at zero. Okay. My point is this: if you had known this strategy before, you would probably never even get here. But what if you did have a line of credit? That would kind of be like your safety raft, right? Like you don't end up like all these people on TikTok about how they're angry and not going to pay back their student loans. And, if you make that decision, then okay, well, they'll just garnish your wages, right? Right. So bad times for everybody. And I'm telling you, a lot of people who eventually end up seeing the light, and then they're like, they can't unsee it anymore. And then you realize you're in the matrix, right? All these people are in the matrix, all of them. Making rants on TikTok videos about how they, student loans will do this, and rather than just paying your debt, right, and pay it off relatively quickly. Okay, be like Dave Ramsey here, but Dave Ramsey would yell at us because we're going to use a line of credit, which he doesn't like. Okay. All right. So let's go ahead and do this. And let's say we had $100,000, 8% line of credit. Mine's actually 7.5%. But what we're going to do is move our debts based on what we call a cash flow index. And if you don't know what that is, it's basically a formula of the balance divided by the minimum payment. And so you see all of this, right? You see all of this. And so what we do is we apply the formula, and think of this as a ranking system. We take the lowest ranking ones, we'll say below 50, okay, and then move it into line of credit to increase our cash flow. So how much is this? This is 5, 8, 15, 27, and then right here, and then it'd be 55,000. All right, so 55,000, 55,000. Okay. So what happens when we simply just shift the credit card debt? Okay. Well, these payments essentially go to zero, right? For credit cards. So look at that. Okay. This is like the most clickbait moment of your life that you can't unsee. Okay. How do we go? Remember, same income, and all we did is shift some expenses and not save money. How do we go from $246.77 to $2,000 a month? Right? How do we do that? With the help of something called a line of credit. We're going to throw all of our money into debt. And so the final step is you put your entire paycheck into that line, 6,500, and then you take your expenses out, and then you rinse and repeat over and over again. So $2,000 a month is the amount that your debt will go down, plus some interest for using the line of credit. So let's go ahead and get the next month's balance is G2, H2. So you take these two numbers up on top, and then you subtract our cash flow, which is 2024.27. All right. And then what we do is we take the interest, which is based on the average daily balance, multiply it by the interest rate, and then divide it by 12, right? Because the interest rate is quoted annually, but it's calculated monthly, therefore you divide by 12. And so again, can you really unsee this? I mean, think about this. Like, this is a huge jump. And a lot of people struggle with credit card debt, right? And all we did was shift the debt. And then now we're going to dump all of our money into debt. Okay. So now all we do is just copy and paste, copy and paste, and copy and paste. And then you see how easy that is? This is so easy, right? Oh my goodness. All right. And then now we see that in 30 months, all that debt is paid off. Beautiful. Beautiful. Okay. So 30 months. And then this was, what was it? 55,000. So 55K. All right. And then now here. And then, okay, now we're going to tackle on these loans. And actually, let me do this. I probably need to reset this because I've been doing this situation a long time. All right. So now let's go back here. If we type in 30 months in our loan calculator, right? 30 months, we can figure out what the current balance is. So I just type in 30, 30, 30, 30, right? And then we'll just use the cash flow index, okay? And so here's a good one. So let's go ahead and pay off this one first, right? 11 grand. So look at this very low number, 11 grand for $400 of cash flow. Let's go ahead and do that. And I'm going to move this here. So we're going to add the 11 grand. So 11930.51. And then we're going to increase our cash flow by about $400 a month. And then now our cash flow is about 2,400. 2,400. $2,437.55. All right. And then take a look at that. 35 months paid off. Beautiful. Beautiful. Okay. So now, this is 35 months. And then this is 55 plus 23. So 78K. All right. So now let's go back to the loan calculator, 35 months. So this is 0. This is 35. Whoopsie. 35. 35, 35. Let's get rid of this one, 6 grand. Okay. So this is going to be right here. Move that into the line of credit. So this is going to be plus 6,334.78. And then we get an extra, I believe, $100 back in our cash flow. So this is going to be 0. And then now it's 2,500, right? So actually I could just do this and, well, hold on. $83.63. All right, so now let's just do this. Whoa, that's pretty cool. So 1, 2, 3, so 3 more months. Okay, so 38 months, this personal loan is paid off. So right here is this personal loan, 38 months, and then this is gonna be 78 plus 10, which is gonna be 88K. Okay. And then now we're at 38 months, right? So this is 0, and then this is 38, 38. And then, okay, so now we're at 60 grand, okay? Cash flow index 65. It's okay. So let me go ahead and move this one into the line of credit. Let me go ahead and do this. Okay, Control V. Plus 60401.22. And then what's our cash flow now? It's an extra $900. And then this is going to be 3,512.50. And I'm going to do this. Control V, control values. And then let's update our cash flow, which will now be, wait a minute. Did Did I screw up? Why does it say 2437.55? Did it only, hold on. Okay, so 2583.63. I don't think it's going to make that big of a difference, but I probably screwed up. 25, 8, yeah, 25. Okay. So now this is going to be 0. And so 3512.5. Okay. So now let's do this. So we're going to type in 3512.5. And let's see how long it takes to pay off that student loan that so many people are fearing paying back. All right, so, all right, 56 months. So 56 minus 38. So 56 minus 38. So 18 months, not bad. Not bad. So you could have paid it off in about a year and a half. So instead of not paying it, not freaking out that student loans are going to be repaid, have to be repaid for 5 years, you could have done it in 1 year and a half. Okay. So, all right, let's go back here. How many months was that? That was 56 months. 56 months. And then this is going to be 78 plus 80, so it's going to be 158,000. All right. And then the mortgage, okay, the mortgage is right now 56 months, so this is 0. 56 is at 222,000. Okay. Now, I'm going to warn you all, because you hear this on the internet, is just, oh, loan bad, line of credit good, and that's simply not true. This 2.5% mortgage takes up an itty bitty amount of cash flow, right? That's what this huge cash flow index number means. So would you give somebody 222,000 to get $987 back in your cash flow? Most people would not, because it's a relatively small amount, right? And so one of the things that you kind of have to be aware, like nuances, is that if you move this whole loan into a line of credit and it's a low interest rate and the line of credit has a big interest rate difference, you're probably going to end up paying more than you have to, right? And I've never really seen an exception to this, but a 30% credit card, when you pay it off in small chunks, will do better than an 8% like loan replacement. Okay, so let me go ahead and demonstrate what I mean. So give me one moment. All right, here we are with the Velocity Banking Calculator. So let me go ahead and type in the information right here. And what's our income? 6,500. And our expenses is everything except for the loan we're trying to pay off. So that'll be $2,000 right here, 2000. Okay, and the chunk amount is just how much are we moving into the line of credit. So for example, let's say I fully replaced the mortgage, okay? So it takes me about 5 years and I pay about 29 grand less interest than I normally would have had. So it looks impressive, right? But what if we just did this? Pay it off in small chunks, okay? If we're going to use a line of credit to pay it off, $7,000. Look, 13 grand right here, 4.4 years. And here's the crazy part, all right? 30% credit card in small chunks. Look at that, 17 grand. See how that works? Isn't that crazy? Isn't that mind blowing? 30% will beat that 8% replacement, right? And you might even want to use a 30% credit card because, if the credit company or the credit card company sees that you're swiping 7 grand a month, they're probably going to give you more credit, right? Because they'll be like, whoa, this person doesn't need money. How are you making $7,000 purchases and paying it out so quickly? So we'll give you more money, right? Banks don't lend money to people who need it, right? So let me just reset this right here, 8%, and then 4.4 years, okay? 4.4 years. So this is going to be 56 divided by 12 plus 4. 4.4. And then we're 9 years, we are debt free. I mean, think about this. Like, if student loans were paused for 5 years, you'd just be debt free in about four if you did the strategy and actually paid your debt. But what usually happens is that if you go in those income based deferral or payment programs, your loan balance actually will probably grow in like 5 years because, again, debt is meant to be, I don't know if attacked is the right word, but if you don't, if you put a very small payment, okay, into that debt, it's not going to go away. It's actually going to increase, right? It's the opposite of amortization. Amortization just means the loan's going to go away after you make payments, right? And if you have an income-based repayment program, um, you, your payment's going to be so low that the debt is going to keep growing, right? So that's the opposite of amortization. Anyways, all right, so that's it for today, folks. This is a Korean Atlanta mentorship. So I usually have a key phrase, a word of the day. So I need to really quickly think about what it should be. So this is so you can let me know you watched to the end. So type in the comments below. Cannot unsee this. Okay, cannot unsee this. Okay, if uh if you watch to the end of this video, okay, that type it in the comments. And yeah, I don't know, like sometimes you watch this and you go, whoa, how did I get from here to here without making more money, right? Like relatively easy. I do this all the time in spreadsheets, budget here, velocity banking here. I never want to save money again, right? That's such a waste of time. All right, well, that's it, folks. Have a great day. It's Korean Atlanta mentorship. I'll see you on the next video.